Ah, yes, this number, the price of a share, or also commonly referred to as the stock price. It can be the reason why you are configuring your dream car after your $1,000 investment increased about 5% in value, or the reason why you have to apply at one major US fast food chain because your paper handed you a Build-A-Bear trade in 2020. It's crazy how much significance a made-up number can hold in your life and impact it. In Greek mythology, while Sisyphus pushed a boulder up a hill, hoping to someday reach the top, that boulder in our life seems to be the relentless chase of understanding what makes the stock price go up or down. And it seems like no matter in which direction you actually push, the boulder seems to always roll away and then crush you somehow. Let's look at an example. Tesla sales down all across the world. This must mean a sell-off, you think?
Wrong.
Tesla is up 8% after earnings. Nvidia chips banned in China. Nvidia all-time high that same day. Intel, the once thought too big to fail company, gets eaten alive by a measly performance, increasing debt and bad earnings, and even this one degenerate invested his grandma's heritage into right before Intel lost X amount of dollars in market value in a single day. This must be a falling knife, you think. And then bam, Orange Man comes and saves the day, announcing a government stake into the company to strengthen chips manufacturing in the US and thus crushing your trade. Intel up 40% year to date. And then, after all of this, even when you think you have figured it out now, you will just inverse it this time. Google beats earnings and reaches a new all-time high every day. It seems like the harder you are trying to understand the stock price and what turns it on, the more money you will lose by doing so. As our beloved hedge fund managers always say, the trade is always greener on the other side. And by the other side, I mean their pockets. We investors love to see patterns where there are none. And the more you learn about investing, the more dumb ones you will see in your life. Take this chart for example. What can you see? This is clearly a dinosaur, right? Which means the company is going extinct. Or here, the hanging bad reversal pattern, which I have no idea what it means. And of course my personal favorite, the real Batman Dark Knight pattern, showing us that apparently it's the right time to throw 40k into Ethereum. There will come a day when you have spent so much time in front of your screen that even the outside world will give you hidden signs and make you go crazy. Maybe to better understand this number, we have to dump down, as in, knowing too much about something is the exact reason why we are failing day to day. When I talked the first time about stocks with my ex-girlfriend, she for example said that she buys the one that costs the most because it must be better and more valuable. Of course, if you know anything about investing and basic math, you would know that this is the equivalent of choosing the 50-cent coin over the €1 coin because it's bigger, or a quarter over a dollar because it's more shiny. This comment back then reminded me of the wealth inequality and how evil Elon Musk must be, because why can't he just give each of us $1 billion? If he really wanted, he would do it. But anyways, who am I to judge? While I'm up a single digit since then, she was outperforming the market because Mercury was in fact in retrograde, and apparently that meant it is a good time to invest in Amazon and Google. You do not have to know the difference between revenue streams of a company or read any of this garbage as I did. You just have to trust in the universe and believe. The technical term you will find in financial literature to describe this heuristic would be vibes-based investing. And what a vibe she had. Through those vibes, she somehow, and I kid you not, was also one of the same persons who once bought the wrong Zoom stock during the pandemic and somehow still made a quick two-bagger. But hey, at least I can understand and explain to her fancy gibberish like priced in, IV or PE ratio. For me, it was actually shocking to learn how many people don't actually understand where the price of a stock comes from. When I was younger, people who were more into finance and had built up the necessary capital while I was busy sleeping and playing outside during the housing crash in '08 always shared the common man wisdom of choosing your investment by asking 3 simple questions. Do you like the product of the company you want to invest in? Do other people like it? And do you think the company will still exist in 10 years? The success of these 3 simple questions was confirmed during COVID, when suddenly everyone became an investment expert, which was also coincidentally the time when interest rates were at 0 NFTs were seen as a risk-free asset class, with people explaining that a screenshot is not the same as owning the digital code, and pre-revenue startups specialized in the blockchain technology, outperforming the average market return until this day. Sometimes I wonder if I'm into stocks and finance or just into rationalized gambling with extra steps. Anyway, back to the number, the almighty stock price. A number that on its own means absolutely nothing and has to do as much with value as an insider stock pick from Jim Cramer. Let's look at what I'm trying to say here. Adidas, which was a top growth pick by Jimmy last year, currently trades at a slightly higher price than all of our favorite company, Nvidia. Now, let me ask you, does it mean Adidas is the better and more valuable company because its share price is higher than Nvidia's? Of course not. That's like saying you're rich because you own a million Zimbabwean dollars. I can understand where this misconception comes from. When you go to the grocery store and see 2 bottles of wine, you might assume the more expensive the bottle, the better the taste, while the cheaper one can only be garbage, because how else would you get quality for such a low price? This is called the price-quality heuristic, or in finance, how bag holders are born. To know what the company is actually worth, you need 2 pieces of information. First, the stock price and the total shares outstanding. Basically, how many slices the pie has. Adidas has about 180 million shares, while Nvidia has around 24 billion shares outstanding. Multiply the shares outstanding by its stock price and you will see very quickly that Nvidia is worth more than Adidas. Even though Adidas slice costs more, meaning the stock price just tells you how much one slice costs, not how big the pie is. Now that we understand that this number on its own doesn't mean anything, let's talk about where it actually comes from. To value a company, investors use all sorts of witchcraft, but the most fundamental tool is the discounted cash flow, or short DCF. If you take away anything from this video, just remember this abbreviation. You can even throw it around at the upcoming Thanksgiving table and be their little Buffett. I want you to think about it like this. The stock price reflects the present value of all future cash flows, divided by the number of shares outstanding. Now, you might ask, what are future cash flows and what the hell is the present value? To which I would say, give a man $1 and he eats for a day, teach a man about discounted cash flows, or by that means anything about the stock market, and he loses everything within a week.
Mutual fund, then we'll reinvest the earnings into foreign currency accounts with compounding interest and it's gone.
The future cash flows are basically an assumption you make about how much cash the company makes in future years. If you, for example, start to notice that the college chicks who make bad decisions but still want to have a nice butt start to not only spend daddy's money but also some buy now pay later on overpriced Lulu, you might anticipate that there are still some growth years left until you see your hideous aunt jumping on the matcha and Pilates bandwagon and the stock tanks again, which would mean an anticipated revenue increase for Lulu over the years. It's actually what the people around me meant with that third retarded question for considering stocks back then. Do you think the company will still exist in the future? If you believe we will still be paying $35 for half a burrito from Uber Eats in 10 years, then maybe it's time to invest. You're already making a forecast, one that analysts just turn into spreadsheets. To turn those assumptions into a stock price, you need something called a discount rate. Think of it like a trust tax on your money. If you lend cash to that one kid who talks about index funds, dollar cost averaging, and swears on the one-ply toilet paper because compound interest never sleeps, you don't expect much extra in return. But if you lend it to your buy now pay later addicted cousin who still owes you from last time, you'll want a higher rate to make the risk worth it. The discount rate thus adjusts with the implied risk you're undertaking, and it can completely make or break your DCF. People in the field usually just take the risk-free rate, which are US treasuries, and slap on a market premium to land at about 6 to 10%. Once you have your future cash flows and discount rate figured out, you discount all those future dollars back to today's value. Basically, the reverse of calculating compound interest. Like in the 1 month where you quit stock picking and options for real this time, and you try to calculate if a 7% average market return makes it possible for you to retire at 40, given that you only eat rice and grass for the next 10 years and invest those savings into Triple Q. What I'm trying to say here is that when you discount future profits, you will know its value today. The question you answer is how much money would I need today to have one money in the future? That's where we learn about the time value of money, which is the idea that a dollar today is worth more than a dollar tomorrow, because today's dollar can be invested, spent, or in your case, gambled on an over-leveraged position. By discounting all future cash flows back to the present and divide that number by all shares outstanding, we get a rough idea of what the business is worth today. By comparing our calculated value with the market price, we can finally understand what Warren Buffett has done for all his life, screening for under or overvalued companies. A company is overvalued when the price of your model is lower than the current share price, and undervalued if it's above. It is that simple. Actually, I was just testing you. It's the other way around. For running a DCF on a company of your choice, the first time, only two scenarios exist. Either your calculated fair value is off by $500 from the current stock price, by which you ask yourself how anyone could invest in this garbage company, or your calculated fair value is off by $500, forcing you to make some adjustments, and tada, you only needed to forecast a reasonable 100% year-over-year revenue growth for the next decade to achieve the current market valuation. With your model now only matching the stock price, you can tell yourself that you have done your due diligence, everything is overvalued anyway, and that now is a great time to invest. The crazy thing is that when millions of investors, analysts, and algorithms all run their little calculation at once, given slightly different assumptions, biases, and caffeine levels, their collective guess becomes what we call the market price, which means it's just a weighted average of everyone's delusions, constantly updated in real time. If more and more people and institutions during a given year assume that Labubus will replace pets by 2030, PopMart stock will probably rise. If more and more people and institutions think that The Rock will win against a Tesla robot by KO in a boxing match in 2030, Tesla's stock price will probably drop. The only way a stock price can rise or fall sharply is when the closed system we call the market gets new information, which is usually when the quarterly report and the guidance are published, because it lets every one of us investors adjust their own model of future cash flows, no matter how elaborate this model might be. Another good example here are press releases, since they release formally unknown information to the market. This is also why, outside of US Congress, insider trading is strictly forbidden and punished, because information asymmetry is the only way you can react before the market does. So yeah, that's the stock price in a nutshell. A meaningless number made up by bits, bytes, and corrupt Wall Street algorithms that we pretend to understand, worship like a god, and then let our day be ruined when it drops by 2%. All this understanding to get outperformed by someone who invests blindly in an index fund or who thinks BlackRock and Blackstone are major players in the rare earth market. Thank you for watching and see you on the other side of the trade.